So the first setup is what I call large buyers or large sellers defending price. And this can best be seen by understanding the role that volume plays in how price moves and how an auction facilitates trade. So on the S&P 500, and this is all I traded this month, is the ES future contracts. On April 8th, we can see the market have a very large aggressive sell-off to the downside. Now, this setup that I took resulted in an $8,400 profit with 15 full-size ES contracts. In regards to position size, it really is dependent on your futures trading broker and how much money that costs and how much margin is needed. However, what's most important here, and with all the setups that we're going to go over, is the R multiple. How much was I risking compared to how much I was gaining? In this setup, my R multiple was 4 to 1. So essentially, I was risking $1,500. If I am wrong on this setup, I would lose $1,500. However, if I am correct on this setup, I would gain $6,000. Now, you're going to say, hey, Carmine, you made $8,400. How come your target was a $6,000 profit? Now, this is where you can capitalize on scaling out or holding runners to get more than your planned target. How I look at targets is they can be static in the sense of if the market comes to your target and it's very strong, then you should roll the dice, put more risk on, and hold that position until that strength begins to die down. This is how you can compound gains. So I look at targets to be more static and risk or stop losses to be more structured and set in stone, right? You want to accept how much we are going to lose when we're wrong or a thesis gets invalidated, but we also want to be able to extract the most amount of profits out of the market when we are correct and when the odds are in our favor, because by the end of this setup, I made a 5.62 R multiple. So going into the setup with large buyers and sellers defending price, here in the first 12 minutes, we could see the market had aggressively sold off straight down as soon as the bell rang on the S&P 500. Now, pulling up the heat map here, what we're going to see is as the market was aggressively selling off, and if this looks like a solar system chart to you, I have plenty of videos on my channel in regards to how to read in markets auction and how to understand how volume affects price and how price affects volume. So here we could see the 9:30 timestamp. This is where essentially the market had opened up. Let me make this a little bigger, 9:30. Here we could see the aggressive sell-off into 52.46, and pulling up the chart, the same thing is shown there, the aggressive sell-off into 52.46. So on the heat map, what we're going to see here is as the market was selling off, there was some significant sized red bubbles, and what that translates to is aggressive selling, which is hitting the bid. Now, would people use like a time and sales, or they just use order flow? They translate red bubbles or they translate trades hitting the bid as selling, which is true, but you have to put into perspective of a market's auction that technically, if somebody is selling, somebody else has to be buying. And this is where context is very important. So here we could see the market had aggressively sold off, and pulling up a depth of market, you can see all the red negative delta under the volume profile delta column here, which indicates tons of trades hitting the bid. Now, as the market's selling off, what it looks like on the chart, again, is this right here. And this is, again, why context is so important. That despite all of this aggressive selling, the market rebounded and the market rallied up quite nicely. So yes, technically there is trades hitting the bid. However, for every seller, there is a buyer. So because of how fast and how strong the market rallied after all of this selling, about 10 minutes into the market being open, this became a significant level that I am cautiously keeping my eyes on if at some point in the future the market retests this level around 52.49 to 52.46. And if you were to look at a depth of market, there was a volume tail down there. So I'm going to mark this by this rectangular box, and I'm going to make this a little bit bigger, that if at some point in the future the market comes back down into this level and it holds, then this would indicate contextually that despite all of this selling, somebody may be passively buying into the market because of how aggressive it moved up from this. Now, it took about 30 minutes after this until the market retested this level. And in the intraday commentary tab of the InvestiTrade community, this is essentially where I post my thoughts in real time and the levels I'm watching. And every single trade that I have taken is posted in here in real time, so there's no hiding behind wins or losses. The market sells off into this level, and I was viewing this as a sign of potential buying here at 52.50. I'm trying along, targeting 52.58, then pre-market highs, and my stop loss is under 52.48. So how I have small losses is I am confirming my setups and I am getting confirmation by reading the volume patterns that I am spotting with buy and sell orders using tools like a time and sale, level 2, or a depth of market. So that's how I get very good risk to reward ratios, and I'm confirming it and I'm trading on the correct side of buyers and sellers. So going back to what I said earlier about this being a large seller defending or large buyer defending price. Here we can see the large buyer, which caused the market to rally about 12 points off of that. And that's the level that I am watching if price action comes back into it and holds. The market sells off into this, and at 10:08, I get valid confirmation to take the market long at 52.50 with my stop loss being under the 52.48, which was directly under this low right here. So very, very minimal risk, targeting, number one, a breakout above this resistance level. And above that, I was targeting the high of day / pre-market highs, because this is the only other levels that I could come up with. What we see here is tough resistance. So my thought process and how I develop my targets is I say, okay, I'm first going to target where the market had a hard time getting above. And that was at 52.58. And that was my first target, 52.58. And then above that, I would be targeting pre-market highs. And this is how I structure all of my trades. If then statements. If the market breaks through this level, then there's no other resistance or there's no other supply until the 52.66s, right? I have no supply or resistance. If the 58s break, targeting the 66s to gain an extra 8 points per contract. So the market sells off into the level of interest at the 52.50s and begins to rebound. And this was a trade that worked out very well. Now pulling up the order flow here, what you're going to see is I can fast forward this action. You're going to see a dip down into this level. And you're going to look at the depth of market and you're going to see all of this aggressive buying step in. Now in this moment, I am entering the position. I'm not waiting for a candle to close. I'm not waiting for the 5-minute chart to have a green bullish hammer bar. I am simply getting in when the market's telling me to get in. And when the market tells me to get in, when I am spotting large buyers defending price, because now my risk is minimal and my reward is much higher. And if I were to fast forward this trade, you're going to see the strong breakout into the 58s where I scale out majority of my position. I am scaling out along the way as it's breaking that resistance level. So I exited half on the breakout of that. I then adjust my stop loss, right? I'm bringing my stop loss higher. So I take risk off of the table once my first target hits. And then I get all out once my final target hits. And this is how you can get very creative and capitalize on spotting large buyers and being able to get in a position with minimal risk and capitalizing on a 20+ point rally into my final target. Now, the next setup is going to be the same thing, but just talking about sellers defending price. And this is going to tie risk management in very well. So similarly to the other setup, this had a 7-to-1 risk to reward ratio. When I am trading using order flow methods and methods of using volume and how it affects price, it enables me to get such great entries that my risk is very minimal. So I traded 15 contracts on this setup, risking $1,500 to make about $11,000 if I am correct, a little over 7-to-1 risk to reward ratio. I always get questions like, hey, Carmine, how come your losses are very small compared to your wins? And it's because I am entering in the present moment. Whenever I spot large buyers or large sellers, I am simply entering and I'm placing my stop loss where I am incorrect on the setup. And due to how precise the entries could be, because of how leading The indication of buying and selling volume is it enables me to trade in this way. So very good risk to reward ratio, and I took a loss on this setup, which was a $1,500 hit. Now keep in mind, look, I got short up here and I stopped out up here. The same exact day, this is April 29th, the next minute that I stopped out of that position, right? I stopped out up here, I re-entered short for a 10-to-1 risk to reward ratio. That's the best case scenario. And I got a $6,500 profit out of the setup because of my first scale and because of what I thought the market was providing me in that real time. So still, $1,500 loss compared to taking the same exact setup, but when I am correct, it's a $6,500 win. I could take 4 losses and 1 win, yet still come out green on the session. Imagine having a 20% win rate and coming out green. This is all relates to your risk management parameters and how you are confirming your setups. If I wait for a candle to close, right? So let me just pull up this setup right here. If I wait for a candlestick to close, right, it may be too late to enter. I am getting in as soon as I see that selling volume step in. So for this setup, let's just go over the commentary so you can understand this a little bit better. What I was watching for was here you could see as the market opened up, it left a strong trail of very, very aggressive buying. So my thesis kind of revolved around 51.49, which is going to be this green line, that I knew if the market could get under this green line, it would cause these buyers to be put in a little bit of a pain, and it would put them underwater, and it could bring more selling pressure. So essentially the market sells off very aggressively, and what I was watching for was as it sold off and put those buyers in pain, my level that got developed was 51.49 to 51.52. Now, if I pull up the order flow here, what you're going to see at 51.49, number one, on the depth of market, at 51.51, you're going to see a positive delta of 1,000. So there's an outlier in the data there at 51.51. However, at 51.49, this essentially is where the larger selling began to really step in. So I made my level from 51.49 to 51.52. And if I was to extend this, I am waiting for price action to revisit this level of interest. That if sellers can come and be present here, this can fuel an area for sellers to reload and potentially take a short setup. So pulling up the chart again here, the market rallies into this level, and around 10:18 is when I took that first setup, which resulted in a loss. I was eyeing a potential short. I saw it rallying up into this level, and if you look, the candles were getting smaller. So a very good tip is if you see the candles getting smaller and you see the volume dying out and you see less traders hitting the offer, and this can be spotted especially using the order flow, this is a very good indication that a potential seller can be looking to reload, or this could be a very good area that sellers can become present that offers minimal risk to take it short, and you could flip this to the long side. So right here, 10:16, I'm going to pause it. I saw the market rally back up into these 51s where that negative delta was of a positive 1,000. I saw the buying getting weaker and weaker, right? As the market was moving up, the buying was getting weaker and weaker. And I viewed this, okay, the market's coming back into my level of interest. This is where sellers were once present. If they reject the market again, it's going to offer a great opportunity for me to take the market short with minimal risk. So we come into this level. We see the rejection, right? I'm not waiting for a candle to close. I'm getting in as soon as I see the seller step in, and I take it short with a 2.5 stop loss, targeting 12 to 14 points. So excellent risk to reward ratio, retesting that level. And then I covered at my stop loss at 1034 for a 2.5 handle loss. Now, what a lot of traders do is they take the first loss, right? And they think, oh, I just took a losing trade on that setup. I have to be wrong. Or I'm throwing in the towel. I'm upset. I'm going to call it a day. I have a loss rule that if I take a losing trade, I can't trade again, right? Just because you lose on a setup does not necessarily make you have to throw in the towel on your analysis. You may have simply just mistimed the market. In fact, my best setups usually occur like this, where I mistime the market. Maybe I get in a little too early. Maybe I'm jumping the gun a little bit with valid confirmation. I take a losing trade on it, but as soon as I stop out, I re-enter maybe in the next minute or 5 minutes. And the next setup, because here was a $1,500 loss, the next setup completely outweighs the original losing trade. So my advice is, if you take a loss, don't throw in the towel and don't get upset. Maybe you just mistime the market. Maybe better confirmation with smaller risk will come at some point in the future. So immediately after I stopped out, in the same minute, if you look at the timestamp here, 10:34 is when I stopped out. The same exact minute at 10:34, I am looking for a possible re-entry here. My analysis is still not incorrect. I may have just mistimed it. So I want you all to go back, look at your data, and see how many trades have worked out according to your analysis after you stop out. And how many of those trades do you not retake the second or third entry because you're fearful to lose again? You have to remove that emotion, you have to drop it, and trade whenever you see opportunity. Because even though I stopped out, I still found opportunity here. Now look at this. Now I got short at the 51s, right? Now I'm short at the 51s. My original entry was at the 50s. So now I am getting a better deal on this setup, right? I'm getting $1 more or 1 point higher, which means my reward is going to be much more. So now I'm still risking $2, but now my reward is going to be 14 to 16 points, which now, even though I took a loss, going to be able to get more profits if I am correct on this setup. Now pulling up the heat map, we're going to replay this. This is where I take the confirmation to get it short the first time. And you're going to see here at 10:34 is when I stop out of this position. Right here I stop out and then I re-enter, right? It was a little too fast, but at 10:34, 10:35 is when I re-entered again, right? Hit my level at 51.52, selling steps in, and I'm comfortable with that risk, targeting that little consolidation low down here. Market sells off into my level, and watch this very large aggressive drop to the downside, and we're in this position. You know, we're not waiting for a candlestick to close. We're not waiting. We're not delaying our entry for the RSI to say it's oversold. We're getting in as soon as the sellers tell us to get in, or as soon as the sellers say, hey, they're defending price. That's going to offer the best risk to reward ratio, and the market eventually broke the low of day. And this is how you can capitalize on using order flow to get very tight risk with very large rewards, scaling out along the way, and then getting all out once the final target hits. And patience will pay. Do not hesitate. See the setups you like and take the setups without hesitating. I made a post on my Instagram about if anybody had any questions about my monthly stats. If you're not following me on my Instagram, I recommend clicking the link in the description below to do so and follow me. But somebody asked a really good question, that what are the other factors that I take into account if my trade is incorrect other than stopping out or breaking a key level? So this is kind of going to tie into that slightly, where when the new information gets developed, I have to tweak my plan slightly because it wouldn't make sense to follow that plan with the new information that is found in the market. So in this example, what I saw was the market was selling off aggressively into a key level of demand, I believe was at 51.12. And I saw some nice buying volume come out of this level. And my original stop loss was at 51.11 and a half, which was a 3.2 risk to reward. Now I sold this trade for a minus 0.56 before my stop loss triggered, because it would be foolish for me to continue to hold on to my stop loss with the new information that got developed. This will make sense a little bit better now. When I got long, I saw large buying volume step in. However, directly after I entered, I saw the buying volume die out. So it would not make sense with this new information to continue to hold to my stop loss, because my original analysis is less likely to pan out. And how I was perceiving that trade earlier, now I am perceiving it slightly different with the new information the market has presented to me. The market is essentially a mechanism that is constantly giving us and providing us information, right? Like when I wake up, I never know how I'm going to trade it, or I never know if I'm going to be long or short, because when the market's open, it's giving me things that I could never have planned for. In fact, the traders that I know on Wall Street don't sit an hour before the market opens and creates a pre-market plan. They wake up, they wait for the bell to ring, and they say, okay, I'm seeing buyers, I'm seeing sellers, let me make a plan on the fly. And there's so many things when you are short-term scalping that, in my opinion, you have to create plans on the fly with new information that you could not have planned for at some point in the past. So in trades where sometimes there's smaller losses is because I am dumping that position when it's not right for me to continue to hold on to it. Let's say you're in an unhealthy relationship with your girlfriend. She's mistreating you, right? It's not going to make sense for you to stay with her. You're going to dump her immediately and watch the quality of your life completely change. Carmine's dating advice 101. In this setup, it's like me having a bad girlfriend when she's not treating me right. Or if I'm long, the buying volume is not coming into the market, I can dump that. But the caveat to this is you must accept to re-enter at some point in the future if you see better confirmation, similarly to the previous setup that we talked about. So I dumped this trade about 1 point prior to my stop loss to protect myself, and this is how I'm able to get smaller losses. Same thing occurred about 10 minutes after, a minute after I stopped out, I re-entered this setup. And again, everything's posted in real time in the Discord. What I didn't like was how after I was in this setup, there was price resisting an old key level, which was not good for longs. So I get out when I can for a small loss to protect myself. And 4 minutes after I entered that, I re-entered with another 1 point loss. Key for me trying to catch the bottom. It wasn't breaking. Tight risk. I wish I could be correct because the winner will pay itself nicely. But it's dumping a trade when new information you could not have planned for presents itself. And this is vital, in my opinion, for short-term scalping. No one could go in the market and try to predict what's going to happen next. Like I can't say, okay, as soon as I enter, this thing's going to skyrocket, right? But if I enter with the anticipation it's gonna, but I see the buying volume dry up, or I see it rejecting a resistance level, it wouldn't make sense for me to continuously hold to this position to my stop loss and take a loss, whereas I could cut it for a small loss before it becomes a bigger loss. And even if you don't do that and you do hold to your stop loss, if you get great entries, right? Entries, in my opinion, are the most important thing because I rather take $500-$600 losses and the next setup was a $6,000 win or a $10,000 win, right? Maybe I have 6 trades or 5 trades and I lose 3,000, but my one setup that I'm right on it makes me win 10,000 or 8,000. It's completely different. So this setup, I plan to lose $624. I lost $624 the same day. I made a $2,000 profit, right? 3-to-1 risk to reward ratio. I sold this trade because the market lacked the strength and I got out for a small profit. The next setup, $1,800 losing trade. Simply did not work out. I was trying to catch it long and it dumped on me, right? Next trade, $300 loss. Getting out before my stop loss hits because I'm trying to catch a falling knife. So if you focus on maintaining proper risk to reward ratios, once you have a system, that's the most important thing because I'm not in the job to be correct. I'm in this job to manage my risk. My profession is not a day trader. My profession is a risk manager because if I know I manage my risk and I follow my system and I follow my plan, I will make money in the long run. And this month was a very slow month for me. Didn't really trade as much as I did a little bit of traveling. I wanted to just enjoy the benefits of being a trader and, not be so glued to my screens. That's really what we're in this for. Not only the money, but the freedom to do whatever we want, whenever we want. And I'm blessed to do it. So if you have any questions, let me know in the comments. If you're new, I would appreciate you to subscribe to my channel and also drop a like on this video. I would really, really appreciate it. But I'll catch you all in the next one. Peace.